So if retirement's approaching and you're starting to explore your options, you're likely to fit into one of these four scenarios. Let's have a look and see which of these is most like you. So is it Tom? He's approaching 66 and he's about to start drawing his state pension. Or is it number two, Sarah, who has a company pension and is actually thinking about buying an annuity to give her a fixed pension every month? Or would it be three, Mark? He's moving his company pension to a drawdown account and he'll take it as cash as and when he needs it. Just a bit like a bank account, really. Or Lucy, who has a defined benefit pension, where she'll get a payment from a pension provider each month. Or maybe you'll have a combination of some of the above. So let's run through each in turn to see what will happen as you approach and move into retirement. So 3 months before Tom reaches his 66th birthday, he'll receive a letter from HMRC telling him he's entitled to claim his state pension. He's got a full state pension as he's paid the right amount of NI for 35 years. If he takes his pension, he'll receive $11,500 per year. However, he can delay taking his pension for a year or so, and when he does start, he'll receive more. So let's assume he decides to take it from his 66th birthday. The letter tells him he can either call HMRC and provide the details they need to make the payment, or he can go online and fill in a form on the HMRC website. After his birthday, he'll receive the regular monthly payment into his bank account, the bank account that he provided on the forms. If he doesn't have any other income, then Tom won't be taxed on the state pension, as the amount you can earn before you pay taxes is £12,570 at the moment. Tom won't receive any pension credit, though. This is actually only paid to people who don't receive full state pension. Those who receive less than $11,343 per year, or £218 a week. So that's Tom. Now let's have a look at Sarah. She's got a company pension and is retiring a little bit earlier. She's contacted her pension provider and they've sent her some forms to apply for an annuity. This is a fixed income for the rest of her life. Now, Sarah knows not to just go with the provider that they mentioned in the letter. She knows that she needs to shop around really to get the best deal. She can see from her pension provider's statements that they've sent her recently that she has a company pension and that's generated a pot of £310,000. Now, she knows that this is her money and that she can speak with any annuity provider she likes, really, to make sure she gets the best policy. She's decided to buy a life annuity, which is also called a guaranteed annuity. And these can provide a reliable income stream in retirement. But if you die too soon, you may not get your money's worth. And customize an annuity to fit your needs. You may need to pay more or accept a lower monthly income. You can't choose how the money is invested. The income payments will be low if the annuity starts in a period with low interest rates. You can't change the amount you receive in income once the payments start. What you actually do is you lock your money away until the end of the term that the annuity ends. And you can't withdraw your money as a lump sum. So the forms that Sarah will need to complete are quite long and complex, and actually they do seem to be a bit invasive. This is because the insurance company that's selling her annuity need to calculate how long they think she'll live. The longer they think you'll live, the less they'll offer you. So let's move on to Mark. He's put his company pension into a pension drawdown account. You might think of this as a bank account wrapped up in a pension, which you can access as and when you need. The main benefit of drawdown is its flexibility. It allows you to adjust your income based on your needs. For example, you can take more income during the active years of retirement, for holidays, or before your state pension starts. You can also take tax-free cash without drawing an income if you're still working and you don't need it. Currently, the state pension is 66 and rising to 67, but defined contribution pensions have different rules. As of now, you can access these pensions from the age 55. This is changing to 57 in 2028. If you have a private pension, you may have protected age 55 for access, and it's worth checking this with your provider, as transferring your pension could forfeit this benefit. Now, drawdown lets you control your pension benefits, and often by reinvesting unwithdrawn funds to potentially grow and offset future withdrawals or provide income later. You can take 25% of your pension tax-free, and that's 25% of your uncrystallised funds. So uncrystallised funds are pensions from which no benefits have been taken. For example, if Mark takes all of the 25k tax-free cash from his £100,000 pension, he crystallises the entire amount. The remaining 75k stays in the pension as crystallised funds, and he can still withdraw income from this or lump sums, though this income will be taxed at his marginal rate. The official term for the withdrawal of your tax-free cash is a pension commencement lump sum. Let's say Mark decides to take £2,000 tax-free cash. And by doing this, he crystallises £8,000, or 8% of his pension. The £2,000 taken tax-free is paid to him, while the remaining £6,000 is designated as crystallised funds within the pension. He can still withdraw the amount whenever he chooses, but it'll be subject to income tax at his marginal rate. Now, 92% of the remaining pension remains uncrystallised, and this allows 25% to be taken tax-free in the future. However, any income from crystallised funds in a drawdown pension is considered taxable income. So whether it's tax depends on your total income. With the first £12,570, it's tax-free under the current rules. So you don't have to just take your tax-free cash as a lump sum or in one go. It's possible to take a series of smaller lump sums. And most pensions do not usually form part of your estate when it comes to calculating inheritance tax. This can be very powerful, actually, and useful for retirees who may have other sources of income and the value of their other assets are above the inheritance tax thresholds, maybe their home or ISAs, for example. The first real risk of drawdown is that there's no guarantees, unlike an annuity, which is guaranteed. So if you take too much income from the pension, investment returns are poor, or you're just unlucky and you retire before a severe market crash, then there's a real risk that you could run out of money further down the line. Mark knows not to take his tax-free amount in one big lump sum, as he'll pay a huge amount of tax in that tax year. He knows it's better to leave what you can invested, as when the pension grows, so will his ability to take higher tax-free amounts, as it's a percentage of the total amount in the pot. So let's have a look at our final retiree, Lucy. She has a company pension that's based on their average salary and the number of years she's worked for the company. This is known as a defined benefits pension, and we can always calculate how much you get out the pension at any point, as it's based on a calculation. So, say, for example, your average salary of the last 5 years divided by 80 times the number of years you've worked there. That's a classic calculation. And this is protected from the ups and downs of the stock market. So Lucy tells her employer she's retiring and contracts the pension organisation that manage her defined salary pension. They tell her that she's entitled to a pension that starts at £19,200 per year, and this will go up in line with inflation. They also tell her that she has some options. she can take the $19,200 per year, or she can decide to take a tax-free lump sum. However, for every £15,000 she takes as a tax-free lump sum, her annual payment will be reduced by £1,000. Now, she's got a £40,000 mortgage left and would like to take a holiday. So she opts to take £45,000 as a tax-free lump sum, and this reduces her pension from $19,200 a year to $16,200 a year. She's happy with this, as she knows she's now mortgage-free.